So yeah, as Dan mentioned, we're going to run through how you build a portfolio at different stages of your investment path. We've got a risk warning, but I feel like these things are just for discussion only. They're not any advice, and check anything before you buy. I feel like that summed that up well. So when you start out with investing, there are a number of challenges that you have to overcome. One of the first ones that I particularly found when I first came into investing, and I'm sure everyone's found, is that there's a lot of jargon. Fund managers are a fan of an acronym or a technical term, and that can seem quite off-putting to first-time investors. So one of the best things that you can do is not be initially put off by that. Everything's learnable. There's the wonder of the internet where you can search for all of these things now, and you can find out what these technical terms mean. There's also been a recent ruling from the regulator, so the Financial Conduct Authority, who's told fund managers to speak in clearer and more easy to understand language. So we hope that that will help change the industry for the better and help make it easy for first-time investors. One of the other hurdles to overcome is cash. So people have a strong reliance on cash and have a lot of cash within their overall investment portfolios. And there's definitely reasons to have cash for an emergency fund, for money that you know that you're going to need in the next couple of years, or as a kind of strategic position where you're waiting for a particular fund or share to hit a certain price. But broadly, people have too much money in cash. So last year, 72% of ISA money was put into cash rather than being invested, which shows just the reliance that people have. So once you can get over that hurdle and think about taking on a little bit more risk and getting a bit more reward for your money, you can move out of that cash area, particularly as inflation's quite high at the moment. So inflation is around 2%, which means you need to be getting a 2% return on your cash just to keep pace with the rise in prices. Which is another reason why investing is quite good at the moment. So we thought it might be useful if you knew how we got into investing. So Dan, how did you first get into investing?
So I started it, it's kind of linked to when I first became a journalist for the stock market. I got really excited by lots of AIM companies and this small, fast growth. And I made the mistake of going straight into the high risk end of the market. I wasn't really paying attention to the quality of a business. I paid too much attention to how much money I could make rather than how much I could potentially lose. So I've learned from that strategy, and actually over the years I've developed now, well, I only have funds, investment trusts in my portfolio. So I think it's definitely something that people think about. They always think I could go to shares first, but I do question whether that's the right way to go about it. How about you?
So I went the opposite end of the spectrum and went far too boring, probably. But I took a long time to build up my confidence with investing. I worked in the industry for a long time, and you pick up information and learn how to kind of jargon bust as you go. But I probably stayed in safe, lower risk assets for a bit too long. So maybe a blend of our approaches would have worked much better. So for the purpose of this presentation, we're going to break investors down into three broad groups. They're quite broad brush, so you might sit between some of these at the moment, but they're a good way of kind of breaking down different investors. So we've got nervous newcomers. So these are people that are completely new to investing. These typically tend to be younger people, but you can come to investing at any point in your life. Then we have hungry for help, so people that have invested for a while but feel that they need to take the next step and they want to build up more confidence with picking their investments. And then we have confident and in control, and these are the seasoned investors that have been investing in funds and in markets for a while but maybe want to do more of their own stock picking.
So as an investor, whether you've done this before or you're new to this, there is actually quite a lot of information out there. So you have lots of investment platforms, which would be where you'd get your ISA or your SIP or dealing account. They will have lots of information about how to understand the markets. They might have some videos on there with fund managers, or you can go to investment trust websites to get information and fund manager videos there as well. There's lots of investment forums you can go and ask questions to other people. There's lots of people who give up their time and their sort of generous knowledge they're happy to share with you. And also you can look at specialist publications if you want to get really into investing and properly understand what's going on. So this might be Shares Magazine, which I write for, or on a broader basis, you might want to look at the Telegraph, the Times. They have plenty of information on investing. Or simply just read the business section of the BBC. You certainly learn a lot about what's going on in the world.
So if we take the first group, so these are nervous newcomers. We've seen quite an influx of these in recent years. The Lifetime ISA launch, which is the newest kind of ISA, which is primarily targeted at people saving to buy their first home, which means that a lot of first-time young investors have started into the market. And these are people that aren't that au fait with the phrases and terminology in investments and don't really know where to start. So the first thing that they need to think about is whether they want to take a passive or an active approach. So do they want to hire a fund manager to make decisions and pick stocks for them, or do they simply want to buy the market? So buy, for example, a tracker that tracks the FTSE 100 index of companies. You don't necessarily have to sit in one or the other camp. I myself have some passive investments and some active investments, so it's not necessarily an either or, but it's just a factor to consider. And typically passive investing tends to be lower cost because you're not paying for a fund manager, but you also typically would not outperform the market, you'll just get the performance of that market. So one really great place for first-time investors to start is so-called one-stop shop funds. So these are multi-asset funds that spread the investments between stock markets in different countries, between bonds, cash, sometimes some property in there, and it takes the decision of where you should put your money and how much you should put in each market out of your hands, which for a first-time investor is a good way for them to get experience of markets but not have to decide what percentage they want in Japanese equities or in bond markets, for example. And if you're starting out in investing, one good route in is regular investing. So you can set up a direct debit and a certain amount of money will go into investing each month. And you can do that for as little as £25 a month when you start out if you wanted to, and build it up as you have more knowledge of markets and more money to spare. And if you've got no spare cash, which a lot of younger people these days don't, or they're saving up to buy a house, one way that they can get experience of investing is by looking at their pension and what their pension's invested in. So we've got auto-enrollment now, which means that the majority of people will have a company pension. And so one quick, easy way that you can get into investing is to find out the details of that account, log in, and look at what you're invested in and make some active decisions about what you're invested in there rather than staying in the default fund, which is what most people end up doing. And so the next stage of people are hungry for help. So they've gone through that first stage, they've understand some of the terms in the market, they've maybe got a bit more money to invest so they can spread across more funds, but they'll still broadly be investing in funds rather than going into shares. And so they will want to move on to picking their own funds themselves. And there are thousands of funds out there, and it can seem quite overwhelming when you first come to it if you just want a UK equity fund, and there are hundreds, if not thousands, to look at. So favourite funds lists that are available, AJ Bell has them, but other competitors have them as well. These are kind of whittled down lists of those funds. So rather than having to hunt through hundreds and hundreds of funds, you'll go on there, you'll say you want an emerging market fund, and it will offer up 4 or 5 different options. And you can then research those, research the fund managers that are running them, the style that they're taking, and pick the one that's right for you. And these funds the lists are created through some good terminology. They're not just kind of a dart thrown at a board. They're based on past performance, on the fund manager, on fees quite often, and on this range of different criteria. So someone's kind of done the grunt work for you in that.
So on the third category, confident and in control, I sort of assume this is a level of experience through investing in the markets for a number of years. For the purposes of this discussion, I'm going to assume that this category applies to someone who's only got a portfolio of funds, investment trusts, and ETFs. So I think there's 2 ways that they may want to go to potentially add a bit of excitement to their portfolio. So you first of all, you can either buy some individual company shares that sit on top of your existing portfolio of funds, or you can potentially replace all those funds with a concentrated portfolio of potentially less than 20 stocks. And I'll go through each of those ones now. So the idea of having a portfolio of funds that are there if something goes wrong, you've got diversification, something to fall back on, give your investment portfolio as kind of a cushion. And then adding stuff around is called core satellite investing. So you could think of it, the core bit is the serious part, and then the satellite bit is the fun bit on the outside. So I would suggest, if you want to go down this route, to think about 80% of your assets in the core and 20% on top in the satellite. So just some examples of things you might want to consider if you were going down this route. So I would suggest a core portfolio may have something like a FTSE 100 ETF, an S&P 500 one to get exposure to the US market. You might want to have a fund that has a quality bias, or a property ETF. Now, around the side, you may potentially look at adding sector-specific funds, or you can have exposure to something like the private equity asset class. But if you want to add some individual shares, so I think go back to the purpose of it is to accelerate your returns off your sort of core portfolio. So I think you might want to look at a high growth company. So fast earnings growth could equal fast share price performance. Obviously that's not guaranteed, but that's why people perhaps want to get involved in here. It might be a disruptive technology company that's taking market share from one of these boring old traditional players. It might be a company that's moving from loss to profit because the market may ascribe a higher rating for a company with positive earnings. Or it might be an undervalued company where you think that there's a catalyst to drive a re-rating. So these are just some examples, and of course there's lots of other reasons why you might want to have individual shares on top. But if I was to say you want to pick stocks in the first place, and this applies whether you're starting out or you've been investing in funds for a long time, I think it's important to start with what you know. So if you like doing up a car or a motorbike at a weekend, you might be quite good with investing in engineering companies because you understand mechanics and machinery. And if you're into fashion, let's say, you might understand luxury goods companies or retailers. Because when you read their announcements, you can understand the terminology that they're using, and you might understand who their competitors are, the dynamics of the industry. Unfortunately, lots of companies want to give you information and make things sound a bit better than it is. So being knowledgeable in an industry will help you spot when they're trying to pull the wool over your eyes. So I think look at some valuation metrics. Start with the basic ones of price to earnings or price to book value. Get to know those ones well before moving on to other types of valuation metrics. And importantly, I think keep an investment diary. So write down why you want to buy something, and then keep revisiting the rationale. Let's say a year later, if your shares have gone up, it could be because you actually did your research properly. But if the shares went down, go back to what you originally wrote, and you think, oh, I forgot to recognise that risk. I'll learn from my mistakes. I think importantly is we're all going to make mistakes. It's perfectly normal. Don't get down about it. Learn from it and move forward. I think, Laura, for the people the categories you've been talking about earlier, this would definitely apply, wouldn't it, keeping an investment diary?
Yeah, I think particularly when you're starting out, having an idea of why you've bought that particular fund and then revisiting it. So if it has a particular kind of down period where it underperforms, you go back and you understand that that's probably quite normal for that market, or you understood that this might happen, or you go back and you realise this isn't what it said it was going to be, and you know to sell more then. So yeah, I think it just helps you look back, and it also shows you how far you've come, because you can look from the start and kind of see how much knowledge you've gained over time.
Okay, so the idea of taking the second path, which was replacing portfolio funds with individual stocks. Now, I think you do need to be quite careful here. First of all, you think, well, I've been relying on a fund manager so far in my investment career. If I'm going to go it alone, can I really do a better job than them? And do I have the time to do all the hard work? Because they've been doing it before. I think if you're not sure about that, take it one step at a time. Maybe sell one or two funds and add a couple of stocks and see how it goes. Don't jump headfirst into it. So I thought, how would perhaps the average person might want to approach replacing funds with some stock? So I know from conversations with friends and family who might have done some investing that they go, well, if I go for large companies ones that I know have been around for a long time, ones I know perhaps pay a good income, and I hope that they've keep positive earnings. So I made this selection here on the screen of 10 stocks from the FTSE 100, and I think it gives you a good diversification in terms of sector performance. But is stock picking that simple? If we look at the performance figures, I think you'll find out it's definitely not straightforward as that. So if I'd invested £1,000 in each of those 10 stocks 3 years ago, performance, even after factoring in dividends, would have given me a return of only 2%. Now, if you look at the figures here, you can see from the bottom side, Vodafone's had a really tough time. That's because people are very worried about the stability of its dividend. Can it keep affording to pay it? Centrica, well, that's the utility sector. We've had a threat from Labour, should they ever get back into power, that they might want to renationalise that industry. And also there's been a price cap. Imperial Brands has had some problems with, particularly in the States, where the regulators are really quite worried about how this next generation of vaping and e-cigarettes is being marketed to young people. So there's been lots of really solid companies having a tough time. But what the top of the table illustrates to you is, actually, if you pick them correctly, you can do very well. So long term, the stock market has delivered roughly 6 or 7% a year on average. But if you look at AstraZeneca, over 3 years, that has significantly outperformed. The trick is finding these good ones like this. So it is, you do need to work quite hard, and don't underestimate the amount of time it takes to get involved. But investing is really interesting, and if you want to dedicate your time, you might find it become a real big hobby for you. So I'm fascinated by the world of investing, and I think if you are prepared to do it, there are rewards there. You just need to work on it.
So I think the main things that we want you guys to take away from today is that investing isn't as hard as you initially think, and whether you're first-time investors yourself or you're helping out other friends or family or children or grandchildren, it shouldn't seem as daunting place as it might initially to anyone, and that there are plenty of places to get help. So as Dan mentioned, there's lots of websites, there's shares, there's a podcast that Dan and I run, which I wanted to get a plug in for. So there's lots of things out there that can help you guys learn about investing or learn more if you're already seasoned investors.
Yeah, and I think if you're inexperienced, start with ETFs and funds, because you're getting used to putting money into the market, but someone else is doing that constant day-to-day monitoring and trying to make the right decisions, and you get instant diversification, which I think is very important. Building and maintaining a stock-only portfolio can be exciting, very rewarding, but just involves a lot more legwork. But best of luck, everyone. Thank you ever so much.
Thank you.